The firm is an investment advisory firm with $1.7 trillion in assets under management. And Sarah, you were part of our story today where we talked a lot about that crunch on the private equity industry, that pressure to get money back to investors. What does that crunch feel like under the surface to pension funds, endowments?
That's right. Well, Sonali, it's great to see you again. Thank you for having me on the show. So there are really three things that are happening today. And the first is that the big money, so endowments, pension funds, sovereign wealth funds, are not getting the capital back from the private investments that they've made, that they've expected, and that they've modeled out in their commitment pacing plans. The second is that we really need to see a valuation reset in order for more deal activity and exits to transpire. And then the third is that this can be a really great time to put capital, new capital, to work in private markets.
Well, that's fascinating because if investors are demanding their money back, a lot of people around the market say this is to recycle. This is to take that money back in the form of dividend recaps, other leverage, and put that into new private equity funds. But why would you put it into new private equity funds if you're not getting the money back in the first place?
Yes, so this is the challenge. So if we zoom out a little bit and think about how did we get here? So investors 15 years ago or so with zero interest rate environment were really ramping up exposure to private markets, which is what the Fed intended with low interest rates to incentivize risk taking. So lots of money went into private markets, and that worked, and distributions worked in that type of environment. Now with higher rates, what we're seeing is that there are not those realizations happening. And so there aren't the distributions that have been modeled out by these LPs. And at the same time, GPs are continuing to call capital, which is putting that crunch on liquidity. And we just saw an article last week about some pension funds, large ones, who are really struggling with figuring out how to source their liquidity. And when we think about why does this matter? Why do LPs need liquidity? It's really about important missions that they're serving in our communities and in the ecosystem.
What does it feel like under the surface? Is there some sort of liquidity crunch, just given how much private markets have become part of the portfolios of so many big institutions?
Yes, so many of our clients are doing okay. And the reason for that is that the public markets have really masked any potential issues. Should we see a meaningful downturn in public markets, like we did, let's say, in leading up to and during the GFC, liquidity will be harder to come by.
It's fascinating because when you say there needs to be a valuation reset, it's also this sense that returns might be lower, isn't it?
That's right. When you think about what the cost of debt is today, let's take a buyout strategy, for example. Historically, over the last 15 years, the cost of debt was somewhere between 4 and 5%. Today's 9%. Many of those loans are floating rates, so they've moved up, and that's going to eat into the profitability of those underlying portfolio companies and their ability to generate earnings. All their cash flow is going to interest expense. So when it comes time to sell, if those private equity sponsors want to sell, there's a valuation drop, and buyers and sellers are not yet able to meet on price. That's where that valuation reset needs to come in.
So it's interesting. If you say that people are taking that fund, those funds that are returned to them, and then recycling them into other private markets, do they recycle it into new private equity funds, or do they take it and go into other hot areas of private markets like real estate or private credit?
So that's where the CIO, the Chief Investment Officer's job, gets really interesting, is deciding where are those opportunities to put new capital to work. So at NEPC, we guide our clients not to try to skip vintage years or time vintage years, and to continue to commit to your highest quality GPs, because if you lose access and you skip a year, then you're out for good. Now, when we think about other areas where we see really great opportunities, and maybe some great CIOs do too, it's early stage venture where valuations are lower and there's lots of upside. It's buyouts with a value orientation. We don't want to see buyouts generating value only through add-ons and high use of leverage. We want earnings growth and multiple expansion.
Just about a minute left here, but when you see private equity firms turning to debt markets, net asset value loans, to leverage finance, dividend recaps, do you accept that as a form of payment? Do you say that's okay?
Yes, so this is very present. It's actually more hyped up in the media than it's actually happening. So we did a survey at NEPC and found that only about 10% of the proceeds that were coming from NAV loans were being used to recycle capital and distribute it back to LPs. In general, that's really not a strategy that we can get behind. It's not happening as much as you might think.